Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to the Merryn Talks Money Weekly Roundup, our debrief on the biggest stories in markets and economics. I'm Merryn Somerset Webb, senior opinion columnist.
And I'm John Stepek, author of the Money Distilled newsletter.
Okay, there's always a beat there, isn't there, John? You forget you have to introduce yourself on this bit. I'm not just going to do it all for you.
I just had to wake up. Sorry.
All right. Now, listen, we say we're going to talk about the biggest stories in markets and economics. And this week, there's kind of only one story, interest rates. And it's one of those stories that, interest rates matter for everything. But I'm finding it quite difficult to get excited about interest rates this week. But you, on the other hand, you're pretty excited.
I am positively beside myself because, well, apart from anything else, I mean, obviously this was just luck, but I said that the Fed was going to cut by 0.5 point. That was my gut feeling.
Yeah, the reason why I wasn't as excited as John about this was because I didn't make the same correct prediction.
I mean, I do obsessively write about central banks on a daily basis, so possibly one of us has the healthier approach to this than the other. Maybe.
Anyway, listen, the thing that you wrote in your Money Distilled newsletter this week when you were writing about this decision, one of the things you said was the Fed doesn't know something you don't know. And I have to say, I found that really disappointing because one of the things that I secretly hope is that central banks do know more than we know, that they do have special expertise, that when they make decisions, they're doing it on the basis of information that the rest of us don't necessarily have, which is why sometimes their decisions are unexpected. But you say, no, they don't know something we don't know. Things aren't worse in the US economy than people believe. Everything's fine.
Well, it's not so much that things aren't worse, it's just that the Fed's not got information that we don't have. I mean, actually, maybe it does. Maybe the Fed really is like the Vatican, and when you become, Pope or kind of, the head of the Fed, they take you into a wee room where there's a secret recession monitor, and you don't tell anyone else about it. What
is it you think the Vatican knows that we don't know? I think we'll come back to that after this podcast. Anyway, carry on.
We never heard of the Vatican secrets. There's the bit that only the Pope gets to look at. It's all about Atlantis and stuff like that. No, anyway, sorry. I think I may be taking that too far. But yes, I don't think the Fed does know anything that we don't, or rather, you can certainly explain why they went for a 0.5 point without referring to that, because basically now inflation's not the most salient thing for them. Whether or not that's a mistake is another matter. But inflation is not the thing that's scaring them anymore. Now they're a bit scared that, maybe the economy's slowing down faster than we hoped it would. The jobs data is not very conclusive either way, so why not cut by a 0.5 point now, just in case? And then at the end of the day, if things don't look that bad in a couple of months' time, we don't have to cut any further, or we can slow down the cutting. And if things really get, boomy again, then we can always put rates back up. So I think it's more like a precautionary 0.5 point cut.
Okay, and important to remember, by the way, for UK listeners, that the Fed has a dual mandate of employment and inflation, whereas the Bank of England really is only focused on inflation. So it's a slightly different approach, right?
Yeah, and that's true. I don't personally place that much stock in the different mandates because they all kind of boil down to the same thing. But that said, yes, it probably does make the Fed sort of focus a bit more on that side of things. And actually, right before this inflation took off, and I think it's easy to forget this, the Fed actually very briefly semi-abandoned its inflation mandate in favour of the employment side of things, or certainly said it was going to care more about employment than about inflation. And then, of course, inflation took off and suddenly it was inflation's the only thing that matters again. But so this might just be going back to that previously, described approach.
Okay, well, should we cut to the chase? What is it? Sorry, you carry on, John.
Yeah, no, you're right. Cutting to the chase.
Cut to the chase, what does it mean for our investments? What does it mean for US equities? What does it mean for equities around the rest of the world? And we've been talking over the last few months about all the sectors that should benefit as interest rates get cut. So small caps, mid caps, value stocks, infrastructure, etc. All these things that should get a boost as rates are cut. But of course, the immediate reaction from the market was slightly confused.
I mean, the immediate reaction, like in the minutes after it happened, was confused. And I think people have made a bit more of that than is actually necessarily the case. I think with this, you can probably just be relatively uncomplicated and even daft about it. Interest rates have gone down by a lot. That's probably a good sign for stocks. And today, that's what's happened. In the immediate aftermath of the cut, everything went up briefly and then everything went back down. But that's probably just because of the way people were, using markety terms, but the short term people were positioned like that. But today, everything is kind of going in roughly the direction you'd expect. Like gold's up, silver's up an awful lot. It's sort of playing catch up with gold all of a sudden.
That'll make you happy. You've been talking about silver for a while.
I don't own any silver. I don't know why I do this to myself. But
I don't know what you've been doing. Everybody, he's been doing this for decades. He makes great calls, but he never has any exposure himself. There's a miserable old age waiting for you, John, if you don't get a grip and start acting on your brilliant ideas.
It's true, but I can always pretend that rather than being very bored with admin, I was just being having a high level of integrity as a financial journalist.
Quite right too. Now listen, the Bank of England, they haven't had to do any admin because they decided not to move rates.
Yes.
Is that the right choice?
And I mean, but it makes sense. And remember that obviously the Bank of England wouldn't have known what the Fed was going to do when they made the decision. Would that have made a difference? I mean, I do tend to think that central banks are like anything else; they kind of flock together. Absolutely. And social permission. The Fed goes big, all of a sudden it's like, oh well, it's okay for us to do the same sort of thing. But also, I mean, the Bank of England cut last month because they sort of saw the opportunity. Because the other issue the Bank of England's going to have, certainly in the next couple of months, is that inflation is going to go back up, as much because of base effects as anything else. And they might even hit 3% again. So they kind of need to take their chances to cut while it doesn't look contradictory in terms, I think. So maybe in November they'll cut again.
What does that mean for investors and savers in the UK, John? I mean, I suppose if you're a saver and you've got cash in a deposit account, now's the time to try and lock in a reasonable savings rate, because we do look like we're on a glide path to another cut in, say, November. Yeah,
I think that if at any time in the last year or so, you should have probably been looking to lock in the best savings rate you could. And if you haven't done it yet, then maybe do it now. As far as mortgages go, I do think that's a little bit more complicated because obviously the mortgage market is kind of very forward-looking compared to the savings market. And they're already reduced. Like, you can get 5-year fixes quite easily for under 4% at the moment. Maybe that'll tick down a bit further. That's quite possible. But I don't know. It depends on how much further rates actually fall. And I don't see any reason for rates to fall, dramatically. I certainly don't see any reason for the Bank of England to be cutting by 0.5 point in the near future, particularly with inflation where it is. But we'll see. But definitely, locking in savings account makes sense.
Mm-hmm. And we'll wait and see what all that does to the housing market. Mortgage rates coming down a little bit. John, thank you. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. And be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Summer Sadi, production support and sound design by Blake Maples. Questions and comments on this show and all our shows always welcome. Our show email is merrynmoney@bloomberg.net.